I wanted your view on Tata Steel as well. But first up, let's run our viewers through the basic details then and why the stock is actually lower. So first look at it, the EBITDA number on a consolidated basis was better than what we were working with. And there was a beat on both the India operations as well as the European operations. But despite of that, the stock did see some kind of selling pressure. All those numbers should come up for you actually on the screen. First look at it, it appeared like a good setup number. What was the issue then in the past quarter's numbers? Well, UK had a £50 million of one-off benefits due to carbon cost credits. Now, the read-through is basically the European EBITDA per ton loss is at $70 per ton. Earlier, we were working with around a loss of around $40 per ton, which the street was very, very excited about. They've also given us a guidance for Europe turnaround. For Netherlands, they're saying it will turn EBITDA positive in the first quarter itself. That's because production is back to normal post the realignment of their blast furnace. The Netherlands coking coal consumption cost, though, will go up by 20 euros per ton in the first quarter, though currently their purchasing cost of coking coal is much lower. So that positive impact will come in quarter two. Short point is Netherlands turns positive in the first quarter itself. The UK EBITDA per ton will be negative in the first half of the year. That's because of the closure costs, also sketchy volumes, but it will turn positive. That will be EBITDA positive in the second half of the year. On the India operations for the first quarter, well, the coking coal consumption cost will be $10 lower, though currently they are buying coking coal at $30 lower. So that benefit as well will flow through in the next quarter. They also said that the steel prices are up by 300 to around 400 rupees on a quarter-to-quarter basis. So the spreads will improve, but the EBITDA per ton will not improve in the first quarter because they're going to be taking a shutdown, which will impact their volume. So negative operating leverage will play out there. The good news is, though, for India operations, the volumes will be higher by around 1.4 million tons in this fiscal. That compares to last fiscal. On the capex front, they have lined up 17,000 crores of capex. 75% of that will be spent in India. But they have said that there's not going to be any big net debt reduction. And that's why their net debt will continue at around 77,000 crores to around 80,000 crores odd. On organic versus inorganic growth, they're saying they're going to stick to organic growth, no inorganic growth. They're not interested in Vedanta. They're not interested in NMDC steel assets as well. So those are the big takeaways out there. First look at it. It looked beautiful. But then that fine print told us that there was a one-off in the European operations. So not as good as earlier thought about. Deven, what's your view? Tata Steel.